Good afternoon, and we are live with the next episode of Lumida Non-Consensus Investing. I am Ram Alawalia, your host and Chief Investment Officer at Lumida Wealth, where we specialize in the craft of alternative investments. So I'm pleased to join with a friend, Avik Roy. Avik is a policy analyst, and he speaks on healthcare, crypto, economic opportunity. He's a co-founder of FreeOp, Foundation for Research on Equal Opportunity. It's a think tank focused on helping Americans with below median incomes. And he's also been a policy advisor to presidential candidates, including Mitt Romney and Marco Rubio. He's got a background in medicine, the Yale School of Medicine, and healthcare investing. He was at Bain Capital, JP Morgan. He's been a prolific thought leader in the category, featured in Wall Street Journal, CNBC. And here we are at Lumida Non-Consensus Investing. Avik, good to see you again. How are you?
Hey, Ram, I'm fine. How are you?
Good. You know, we first met, I think it was 2 years ago at the Bitcoin Miami conference that our mutual friend David Bailey puts on.
Yeah. You were saying a lot of really smart things about the Grayscale ETF. I remember.
Oh, that was
guy. I got to get to know that guy.
Those was a long time ago, right? I remember when I was speaking to you, we were talking about biotech investing, and 10 plus years ago, I used to allocate to hedge funds, and you had done the same, and you also had invested in the same funds. We won't talk about those funds now. It's 10 years later, the world's changed, different kind of opportunity set. But I remember saying, oh, wow, Avik is super sharp, really enjoyed the conversation. And here we are, you know, we're going to try to solve all of healthcare's problems in the next 45 minutes or so.
All right.
That should be fun. We'll talk about digital assets as well. We'll talk about 13F filings in biotech investing. One of the topics we had, 13Fs are dropping 45 days after quarter end close, are dropping now all around us. And every quarter, Lumina does a 13F walkthrough, actually. So super timely. Let's start with healthcare. So, healthcare stocks have been absolutely decimated. The cost of care, the utilization has increased. So any Medicare Advantage linked name, like United Health or Elevance, has dropped considerably. They're off the lows now. I noticed in the 13F filings have been released, it seems like every hedge fund has accumulated shares, including very notable funds. So I know you can't comment on stocks, but taking a step back, how did we get here around Medicare Advantage, the costs, and what are the issues at play?
Yeah, there's a bunch of things happening, and we're talking specifically about the insurers now, managed care. For those of your listeners and viewers who spend a lot of time in this space, they'll be aware that the vast majority of the equity market cap in healthcare is pharma and biotech. Let's say 10%, 15% is non-therapeutics. But managed care is is certainly a big chunk of the non-therapeutic market cap in healthcare. And the managed care stocks have generally been hammered, and not just the stocks, by the way. If you look at the nonprofit Blue Cross plans, for example, a number of them, not all of them, but a number of them have announced in 2024 significant financial losses. So people are getting hit across the space, even regardless of what part of health insurance you're involved in. So there's specialists that focus purely on low-income Americans, the Medicaid population, like Centene and Molina. There are people who focus a lot on the employer-sponsored market, the commercial market, and then there are people who focus a lot on Medicare Advantage, and sometimes those overlap. But United and Humana, for example, are certainly heavily known, and Elevance for their Medicare Advantage plans, along with their presence in the commercial business. Some of them also have Medicaid presence as well. But across the space, regardless of which sector or subsector of health insurance they're playing in, there's a couple things happening. There's some things happening that the newspapers and analysts are covering reasonably well, which is what they usually focus on, which is what's called trend. So the increase in healthcare spending year over year per capita, that has been elevated. or has rebounded to its historical, let's call it 6 to 8% a year kind of trend, as opposed to during COVID. Obviously, there was a bunch of funky things happening because you couldn't actually get a lot of doctors' appointments during COVID, and then there was a kind of a rebound effect. We're seeing some of that rebound effect now. So people are really worried about that. That's one factor. Another factor is GLP-1s, Ozempic and Wegovy and Mounjaro. What you're seeing in a lot of the newspaper coverage and the analyst reports is that GLP-1s are driving a lot of the increased trend, and that's something that a lot of insurers are really worried about, how to crack down on GLP-1 utilization. I would say, and this is a personal view, my personal view is that there's a missing piece to the story, at least the way it's been covered and reported, and that is AI. So the narrative around AI in healthcare is that, oh, AI is going to be so amazing. We're going to figure out all these beautiful ways to reduce the cost of healthcare by using AI. It's going to be so awesome. And the truth has, in my view, in my assessment, has turned out to be the exact opposite, which is that the initial use of AI today is predominantly among doctors and hospitals and this vendors they use for billing services like Epic Systems for basically using AI to navigate around insurer roadblocks. So if you're
like reimbursement coding roadblocks, I mean the compensation,
all of that. So it's like it's let's say there's a prior authorization saying, hey, you need to fill out all these forms before we will agree to this very expensive treatment. AI is filling out the forms in a millisecond. If you have a kind of a protocol that the insurer wants you to adhere to get paid, the AI agent will basically tell you, but will automate that process for you, so there's no extra friction on your end to hit the insurer's hurdles. And the insurers have been, in a sense, behind the curve in terms of being aware of these tactics used by the providers, again, facilitated by Epic and Athena and the other healthcare IT companies. So the end result has been utilization is higher, not necessarily because people are consuming more healthcare services, but because AI is enabling providers to bill for more healthcare services. So
that's the first time I've heard that, by the way. That's the first. Let me play out the alternative hypothesis. You let me know if this is accurate or not accurate. Alternative hypothesis is you had COVID and people embraced emergency room care. You are seeing emergency room care utilization increase to levels we never saw before COVID, and they've remained elevated. Obviously, some players like Tenet Health are focused on that emergency care. So my hypothesis is that there was a behavior shift, a permanent behavior shift after COVID because people were entrained to consume healthcare. That's one. And they're also telemedicine took off. They consumed it even more. You get a scratch on your back, maybe it's a bite or something, and you call your doctor. So is that a contributing driver? I'll give you one little anecdote. So in COVID, there's a period of time where you couldn't go to the gym. As you know, it's hard to exercise. I started getting back issues and back pain. And so for the first time, I took advantage of chiropractor services on healthcare. And essentially it was like acupuncture and like a massage. And I was like, oh, wait a minute. Is this why healthcare costs are expensive? I'm getting a free massage. I've already had this benefit. I just never utilized it. So what's your reaction to that?
I mean, that could be part of it. But, what really drives trend is not so much those smaller ticket items on a relative basis. It's the big ticket items. It's the person who gets a stroke and goes into the hospital for that, the cancer drugs, the GLP-1s, these things that are multi-billion-dollar spends. That's what really drives the trend more than the smaller things. So it's possible that some smaller things are helping, but I'll stick to my thesis of the AI is really what's the hidden story here that a lot of people don't know about or don't appreciate, because again, it hasn't been quantified. This is I'm putting together what in the investment community we used to call the mosaic theory,
Right.
putting together a lot of puzzle pieces or disparate data points and connecting the dots. And that's what I'm seeing.
Let me challenge you real quick on this one too. Have boomers really adopted AI? Now, obviously, ChatGPT and XAI, they've grown tremendously, but it's the Silicon Valley, the founder types, the New York City types, forward thinking type people listening to this podcast, creators, people on social media. Look, of course, it's over 10 million plus people, but like my parents are not using AI.
It's not the patient. So the way it's working is
the doctor is navigating through. I see. Okay.
There's a small kind of oligopoly of billing and IT systems dominated by these two companies, particularly Epic is the biggest one because they're the one that are in like 90% of the hospitals. The second biggest player is Athena Health, which was actually founded by one of my colleagues on the FREOC board, Jonathan Bush. But basically almost all hospitals and most doctor practices use these products to kind of it's like Microsoft Excel, right? It's like in Google Sheets, right? Everybody, if Microsoft decides that they're going to rename Columbus Day Indigenous Peoples Day, then every calendar on every computer in America suddenly says Indigenous Peoples Day. Nobody, the end user did not make that change, right? So similarly here, Epic and Athena are automating this stuff, and the providers just have to input the chart and the case, and the billing services do the rest.
So is there a winner then in healthcare service providers? Their revenue should be going up. I mean, their stocks have not done too well. Medical device stocks have been fine, like Medtronic and the ResMeds of the world. How do you think about healthcare service provider stocks like United Health and HCA and the tenants of the world? Not commenting on the stock specifically, but
on the provider side, you definitely expect a little bit more of a top line boost as a result. Now, of course, with providers, with hospitals, with facilities, the big question is, top line is great, but like if you can't control your costs, then it doesn't matter if you have top line growth. That's that's really it's really an operational story always with hospitals. On the insurer side, what they have to do now is raise premiums to adjust for this higher trend, which they will almost certainly do, and so that's going to affect the broader economy, right? Because if businesses have to spend more on healthcare, that's lower take-home pay. That's higher operational cost, SG&A for businesses. So there's a lot of downstream, effects, macro effects, you could say, of higher healthcare costs. But it's but how it translates to specific companies, it's you'd have to look at them more specifically. But yes, you should see higher premiums. You should see higher top line growth for the providers. And if the providers are doing a good job of keeping their costs under control, then that should lead to profits or contribution margins for the hospitals.
Got it. Right. So over the last few weeks, we've seen a flurry of announcements that insurers are increasing premiums. Here's a headline from the Wall Street Journal 4 weeks ago: Obamacare insurers seek double-digit premium hikes next year. Healthcare already is a double-digit share of U.S. GDP, and it's the only sector in the economy that continues to have a greater share of GDP year over year, decade over decade, and it's got no sign of turning around, just given the demographic picture. How did we get here? I mean, zooming out beyond AI, like what wasn't Obamacare meant to address this? Now, of course, Obamacare started as this idea of ensuring everyone is insured. It goes back to Mitt Romney in Massachusetts. They ensured that the policy pool contained healthy individuals. So the theory was that premiums would remain efficient. And then the Supreme Court struck down the universal mandate requirement. And then you've had these public exchanges that are still out there. What went wrong or what went right, just given your sense of the accounting of the history of Obamacare?
Yes, Obamacare, which ironically was titled the Affordable Care Act, because then Senator Obama in 2008 promised that his plan would reduce the average cost of healthcare for a family of four by $2,400, which was based on a kind of back of the envelope estimate from a couple of Harvard professors that turned out to be catastrophically wrong. The fundamental design of Obamacare was flawed. Now, this is not to say that we shouldn't strive to ensure that every American has affordable health insurance. Other countries have solved this problem, and it's not just the single-payer countries, by the way. If you look at Switzerland, Germany, the Netherlands, Ireland, Singapore, there are a bunch of countries out there that have achieved universal coverage using much more of a free market or private sector-led model. So it doesn't have to be a government-run approach to get to universal coverage. It's just that the way we've done things in the U.S. has been clunky from World War II to today. It's 80 years of policy mistakes, basically. And Obamacare fixed some things but made other things worse. And in particular, it relied on what was famously called by MIT economist Jonathan Gruber the three-legged stool. And the three-legged stool was, we're going to lard health insurance with all these mandates and regulations and requirements in terms of what it has to cover and the financial structure of the payouts for the insurance products, so that there's much more generous coverage. We know that more generous coverage means the premiums have to go up because there's no such thing as a free lunch. And so we'll subsidize the cost of the coverage, and we'll also force everyone to buy it. That was the theory of the three-legged stool. And it sounds great as a metaphor. The problem is, what if the different legs of the stool are of different lengths? Imagine sitting on a stool where each leg of the three-legged stool has a different length to it, right? Mm-hmm. So that's not really going to be an easy stool to sit on. And so unless those three legs, the regulations, the subsidies, and the mandates are economically exquisitely balanced like a Swiss watch, you're going to fall off the stool. And that's basically what happened with Obamacare. So the regulations were very heavy, very robust, lots of mandates and requirements and things like that to make the insurance more generous, which meant the underlying premiums are going to skyrocket. They doubled pretty much immediately on average. So some people were spending 3 to 4x. And then the subsidies were not large enough to offset those increases in premiums. So most people ended up paying more, unless you were really low income. Most people ended up spending more for insurance than they did before Obamacare. And then the mandate, the penalty for not signing up for insurance, was actually not very large, and there were lots of exceptions to it and loopholes. So basically, you didn't really have to buy Obamacare if you didn't want to. The subsidies didn't compensate for the premium hikes that most people experienced. And so the end result was it heavily subsidized coverage for low-income people. They signed up. But for people who didn't get enough of a subsidy, they didn't sign up. And it was pretty mathematical. It's like homo economicus. Like the people who got a lot of subsidies so that their net insurance costs were cheaper, they signed on. The people whose net insurance costs went way up, they didn't sign on. And the people that didn't sign on were typically people who were either young or healthy or, let's call it, middle class. So they made too much money to get enough of a subsidy. So that's what happened to Obamacare early on. And here we are now. We're in our 11th year of Obamacare coming up. And what's happened? Premiums have gone up every year. And more people are dropping out because the subsidies aren't keeping up with the premium hikes. And so one of the things that's happened is during COVID, under President Biden, Congress, which was then Democratic for a bit, passed a temporary enhancement in the subsidy formula, so that a lot more people were eligible for subsidies than were before. It used to be, it was kind of capped for a family of four at about like 60K annual income, and it went up to like 90 to 110K, something like that. So the increase in the income bracket that you could be in and then qualify for subsidies meant a lot more people enrolled in Obamacare in the kind of post-COVID period from, let's call it 2021 to 2025. But those enhanced subsidies expire this year, at the end of the year. And once they go away, it'll snap back to the old original Obamacare formula. And as I mentioned, the increase in the premiums has not kept, the increase in the subsidies has not kept up with the increase in the premiums. So a lot of people are going to drop out of Obamacare. but who's going to stay on? The poorest people, the sickest people, the ones who benefit the most from the subsidy formula that Obamacare uses. So that's going to lead to premium hikes.
Well, unless you're, say, maybe like a Cigna that's not part of Medicare Advantage, or someone that's providing healthcare with a different model. Is that accurate in your mind?
Well, if you're participating in Obamacare, the rules apply the same to all the insurers. But if you're not, if you don't participate in Obamacare, and there are insurers that don't, then you're not going to be affected by that piece of the puzzle. You're going to be affected by the broader healthcare trends.
Right, and participating in Obamacare means your offering is listed on one of the public exchanges. That's
So in health policy land, we call it the non-group or individual market. So people who purchase insurance on their own, rather than getting it from their employer or the government, meaning the non-Obamacare government, they're in what's called the individual market. So pre-Obamacare, that market was state by state. It was you're paying after-tax dollars for the insurance. So not a lot of people use them because you can use pre-tax dollars if you get insurance through your employer, after-tax dollars if you don't get it through your employer. So there was a massive tax subsidy for getting insurance through your employer, which itself is a big driver of healthcare inflation for reasons we can get into if you want. But yeah, the Obamacare market is right now about 9-10 million people. It's actually gone up to, I think, 12 or so with this Biden era subsidy enhancement. It's going to drop back down.
Here's another explanation for healthcare insurance inflation. There's a famed economist named William Baumol. He had a thesis called Cost Disease. And what he pointed out is that there are certain sectors like healthcare, nursing, teaching, education, where costs just keep going higher and higher. And his point was that we don't have measurable productivity gains in these sectors because they're labor driven, unlike other sectors such as goods, electronics, TVs, automobiles, whatever it might be, where you actually see deflation. His point was that those other areas have productivity gains, and other industries, as they become more productive, they increase the marginal bid for labor, and that can drive some inflation. But here we're seeing like double-digit premium hikes. This is beyond, there are clearly structural issues, at work. If you were to be kind of healthcare czar and you could just snap your fingers and have a different policy approach, what would you suggest?
Well, first of all, I don't agree with Baumol on this. This is the basic issue here is supply and demand. So if you look at the famous charts that show the components of CPI and which kinds of goods and services have exceeded CPI and which ones have gone below CPI, what you see is that the areas of our economy in which demand is not subsidized and supply is not constrained through regulation, those are the areas where prices have gone down over time, right? So tech, computers, TVs, consumer electronics, those are areas that are roughly pretty free market in terms of, you can build new products, you can sell them, there's no subsidy for them. And so there's ruthless competition to make those products better and less expensive. In higher education, in healthcare, what we do instead is we massively constrain the supply through regulation, and we massively subsidize the demand through subsidies, both through the tax code and through direct spending. And the end result is higher prices. It's no more complicated than that. So, put another way, if you want to actually solve the problem of runaway costs or prices in healthcare, what you have to do is you have to go the socialist route, which is to heavily control the consumption and price of every good and service in healthcare. That's sort of the UK model, let's call it. Or you can try to do your best to use market forces to drive competition, to be more selective in who you subsidize. In other words, to means test the subsidies. So you're subsidizing the cost of healthcare for vulnerable populations, for low-income populations, but not for the upper middle class, not for the wealthy. That's what Switzerland does, for example. So have a more means-tested, progressive approach to subsidizing the healthcare, and a much more open approach to innovation in healthcare and the production of healthcare services. So that's what we need to do. And if you want to know, like at FreeOp at my think tank, we do a lot of work on healthcare reform. And the basic, people ask me, it's kind of like the iPhone. It's simple on the surface,
Right.
but underneath it, there's a lot of engineering, a lot of wiring under the hood. And the way I boil it down in an elevator pitch way is, if you want to solve the problem of runaway healthcare spending, both on the public level, which is driving our deficit and debt, or on the private level, which is just the affordability of healthcare, you have to solve for three things. You have to, if you want to do it without raising taxes, if you want to do it by lowering spending on healthcare, then you have to do it by reducing the underlying cost of delivering the healthcare. Because if you reduce the underlying cost of delivering the healthcare, then it costs less to subsidize the healthcare. Yeah. So that's step number one. And step number two is stop subsidizing as many people. If you focus on subsidizing vulnerable populations and you focus less on subsidizing the wealthy and the upper middle class, then you spend less money just fiscally because you're subsidizing fewer people, but you also subsidize demand a lot less, which helps in turn reduce healthcare pricing.
People respond to incentives. There's an economist we both know and admire, Milton Friedman. He had this expression: when people spend their own money, they make a good decision. When people spend someone else's money, they make a less good decision. When other people spend your money, it's a worse decision. And when other people spend other money, it's the worst quadrant you can get. And healthcare seems to be part of this.
No doubt.
I do think there's something else around a lack of accountability in the value chain for healthcare. All the incentives are to spending. I'll give you an example. I saw an anecdote online the other day about a woman whose mother, whose son had an issue. She called the doctor. The doctor said, "You must get a helicopter for your son now. He must be airlifted to a hospital. No, don't drive." They take him to the hospital. They find that it's kind of a non-issue. He was discharged, and she gets a $100,000 bill. And she says, "I did what you told me to do." Everyone has some example of that where the incentives are to prescribe, to consume care, and it reduces the liability for the doctor. There are standards of care that are designed to help manage cost, right? Essentially a flow chart. If these criteria are met, then you have this kind of outcome. But an informed consumer can request consumption. When I go see my doctor, I read Dr. Peter Attia's book, Outlive. I always get APO little b and I get LPL little a in my advanced lipid panel to get additional measurements. So you have businesses like LabCorp and Quest that are benefiting for that increased consumption. You start off by saying there have been decades and decades of bad policy mistakes. Can't we solve some of this by putting transparency in that cost? Like, a consumer doesn't see the price until the end. In every other product and service in the world, you see the price up front, you're making an informed choice, and you have a competitive market. 50 years ago, I had a doctor in my town where I grew up. He's passed away, sadly now, but I asked him what healthcare was back in the day. He used to get tips. It was a different kind of market. Is there something there around introducing price transparency and more accountability at the consumer purchasing decision level, really going beyond deductibles, which are kind of a blanket approach?
Yeah. So I think the question to ask is, and doesn't get asked enough, is why is it that we don't have price transparency in healthcare? When you go to Best Buy, there doesn't need to be a law mandating that Best Buy display prices at the store. They do it because it's in their commercial interest to do so. When you go to the gas station, you don't have to, there's no law requiring them to put the sign up by the road saying, here's what we're charging for gas. They do it because it's in their commercial interest. So why does it not happen in healthcare? The reason it doesn't happen in healthcare is because the consumer is not paying for the healthcare directly. The consumer isn't even buying the insurance directly, except for the poor saps on Obamacare. What people are doing instead is they're getting a card from their employer. Your employer says, hey, here's your insurance card. Go out and get healthcare. And you're like, okay. and then you treat it like an open bar because you just have a card that says you can consume as much healthcare as you want, and it's all good. And that's not only do we have third-party healthcare consumption, meaning a third party is paying for your healthcare, but as you were alluding to with Milton Friedman, a third party is selecting the third party that then pays for your healthcare. So it's really like ninth party healthcare. Right. And that is the fundamental problem. So price transparency doesn't solve that because, if I get a stroke and I'm unconscious and I get wheeled by an ambulance to the nearest hospital, I don't have the ability to shop for that. What I do have the ability to shop for is the insurance company that will do the best job of bargaining with that ambulance company and that hospital company so that the insurance premium I pay in theory is lower than it otherwise would be. The problem is we don't shop for insurance. Somebody buys it for us who has a lot of other principal agent conflicts of interest in terms of which insurance product they go with. And so the end result is it's a total mess. So this is the thing. If we want to learn from, and at FreeUp, we have a whole study we do of the wealthiest countries in the world. We look at the top 32 countries by GDP per capita that have a population over 5 million. And we study their healthcare systems, and we call it the World Index of Healthcare Innovation. If you go to our website, if you just look for FreeUp and then WIHI, W-I-H-I, you can pull it up. And the number one country 3 years running in our survey of these 32 countries has been Switzerland. And what Switzerland does, it's really impressive, is it's universal individual purchased insurance. So kind of like what we were talking about with Obamacare, but it actually works. So everyone in Switzerland shops for their own health insurance, individually purchased. The subsidies are on a sliding scale. So lower income people get a full ride, upper income people get nothing. And you have a choice among dozens and dozens of health insurers, and you have access to the latest technology, full choice of doctors. Many of the largest pharmaceutical and med tech companies in the world are headquartered in Switzerland. Their corporate tax rate is lower than ours. So they're doing everything the right way, and they do a lot of what we're describing. So instead of the employer or the government picking your health insurance company, you pick it for yourself. And
the idea behind the public exchanges to create some consumer choice, consumers making a decision there, except the dynamics you mentioned earlier where people are opting out and therefore the cost of care is going up.
Yeah. So what I would say is the principle of a regulated and subsidized individual market, that principle is a good principle. The problem is that the design of Obamacare did not implement that principle in an economically literate way. And basically what happened was Gruber, who had been involved in Romneycare, was, I guess, misled.
Oh, the Massachusetts program, Romneycare.
Romneycare, right? He was misled by his success in Massachusetts to think that we can just take the Massachusetts model and apply it to the rest of the country. And there were a lot of unique exigencies in Massachusetts that made the Massachusetts case study not really applicable to the rest of the country that Jonathan didn't take into account. And
they generalized from Massachusetts and they don't have a basis to do that.
Exactly.
Got it. Okay. We can double click there some other time, probably. I'm sure it's a rabbit hole. And
I can send you some links.
I'll GPT-5 that one. Give me the reasons why Massachusetts isn't like every other state. What about just the laboratory of democracy? One of the things that I think is incredible about the United States is the concept that different states can have different policies and get different outcomes, and states will learn from one another. Is that not at play here because healthcare is largely federal now due to Medicare and Medicaid?
Yeah, basically that's right. So unfortunately, there's very little room for states to maneuver in terms of how they manage their healthcare systems. There's a couple of things. And because healthcare is so big, if you can even do those couple of things right, you can make a big difference for people. And those couple of things include things like, for example, really being aggressive about anti-competitive practices by regional hospital monopolies. So in most parts of the country, there's one or two hospital chains that basically control the whole state. and they basically exercise that monopoly
Like
power.
Kaiser Permanente, for example.
Yeah, or Sutter Health in Northern California is a famous example because Javier Becerra, when he was Attorney General of California, sued Sutter Health and reached a settlement with them to basically address some of those anti-competitive practices. So that's something that happened, and it's not just price gouging or price exploitation or pricing power. It's also things like the hospital oligopoly or monopoly or leading player will tell the insurer, you must steer all your patients to us, and if you don't, we won't do business with you. And these contract provisions are confidential. They're anti-competitive and technically illegal, but they're confidential. So the insurer feels like if I actually report this to the government, then I'm going to be violating the contract.
You could report to the FTC.
In theory, you could, but the problem is not only a small fraction of these anti-competitive practices can be reported to the FTC, because the FTC will only look at anti-competitive practices that occur with for-profit hospitals at a certain level of scale. So the DOJ has jurisdiction over nonprofit hospitals, or nonprofit and for-profit. The FTC can only look at for-profit. And so there's this kind of fragmented regulatory turf problem. And they also have a lot of other things, a lot of other fish to fry. So the regulatory framework we have is not really working for addressing this particular problem at the regional level, because, the FTC is going to look at things like, when United Airlines merges with Continental, or Comcast merges with Time Warner,
or Google and Apple's pricing.
These big national mergers. If it's like two hospitals in Cincinnati, that's just not something the FTC is going to spend a lot of time on, because it doesn't have national scope. But unfortunately, because they don't look at it in aggregate, that consolidation does have a national impact.
It's complicated, right? The former FTC chair, Lena Khan, wasn't popular at all. Certainly not in pro markets.
It's controversial, we can say. Yeah.
Controversial. On the other hand, there are legitimate grounds, and I agree, like there are monopolies. And by the way, there are monopolies in big tech too. Yep. There are. That's why I own these businesses. They're fantastic compounders with a massive moat. And that's just the reality of it. So it just takes effective usage of those antitrust and FTC powers in a discerning and a precise way to drive the appropriate outcome while not destroying enterprise value. For example, Adobe was denied the acquisition of Figma. Figma went public. It was an extraordinary outcome for shareholders. Actually, technically a win for the FTC. I mean, she's probably like, I told you so. You should have looked at that.
I feel that way in biotech all the time. A great biotech drug will get bought by a pharma company, and everyone's patting themselves on the back for their 100% win on the acquisition. I'm like, if that company had stayed independent, it would have been a 1,000% win, not a 100% win. Now it's part of Bristol Myers Squibb. Who cares? So you lose actually a lot of long-term. If you're a long-term investor, if your time horizon is 5 years rather than 1, or 10 years rather than 1, you have way more money to make if these companies stay independent.
Yeah, no, competition benefits the consumer, and we really don't have a good approach to think about antitrust, monopoly power in the FTC. And these debates have gone back to like net neutrality in the 90s, or say Microsoft and the bundling of the browser. Now Google's being potentially compelled to sell Google Chrome, and maybe Perplexity is going to buy that. At the same time, these monopolies invest a lot in technology because they have the resources to do so. Google, we now have Waymo and driverless cars. So I fact check your thesis on Switzerland around why is it driving healthcare costs lower. First off, I'm happy to hear that there are learnings from countries and places.
Oh yeah,
and so Grok agrees. Grok agrees with you. So you can read the side.
Well, if Grok agrees, then I know I'm on the right track.
Clearly, this is fact and truth. I think it is actually. I like Grok here, but so decentralized governance for flexibility and local adaptation, investment in innovation and technology, digital initiatives such as telemedicine, electronic health records, which is a major issue. It's hard to get your records from one group to another, and part of that has to do with HIPAA compliance, despite the fact that you've got these oligopolies. One would think that this data would be on the blockchain, and then I could authorize someone to access the data with my permission. I'm sure you've thought about this as a digital asset guy. Yeah.
Yeah, I've thought about blockchain and healthcare for a long time. I think in particular it could have some attractiveness in medical records and in supply chain management. But I'm more of a Bitcoin guy than a blockchain guy in general, and I would say that. But I do think that decentralized databases, particularly for patient records, could be very interesting because you want some sort of independently verifiable source of truth. The problem, again, with medical records, to go back to our price transparency conversation, is why is it that you don't own your medical records? The reason you don't own your medical records is because the provider owns your medical records. The doctor or the hospital that did the service owns your medical records. And now there are laws that say they have to hand you those records if you ask for them. But most hospitals in particular put up a lot of booby traps and make it very hard for you to access those records.
You get a CD-ROM. Now, who has a CD-ROM drive anymore?
Exactly. So
how do you deliver it to someone to accept
I do, because I still have like floppy disk drives and stuff in my basement somewhere. But these are all artifacts of the fact that we, from World War II to today, have relied on third parties not only to insure you. That's normal. In every country, third parties insure you. But we rely on third parties to buy the third party insurance. That's the fatal flaw of the American system that countries like Switzerland have solved for.
Got it. Great. Well, let's shift gears to biotech. I mentioned at the outset when we initially met 2 years ago at that Bitcoin conference, we were talking about biotech investing, and we actually had invested in at least one fund. I remember we overlapped, maybe two, in fact. I think it was like Roderick Wong. He's in New York also. And I said, I go through these 13Fs at the end of the quarter because I want to pay 2 and 20 to the hedge fund manager. I can see their positions. And I think it's a misconception. People say, oh, it's stale data. No. These are investments. They're not turning over that quickly. They're going to get capital gains. Do you think 13Fs offer an edge to someone that does the work if they can underwrite who has skill in a particular category?
Short answer is yes, but a lot of asterisks. So I do think that 13F data can be stale, especially if in biotech, there are a lot of binary events, right? So there's clinical trial data, there's FDA decisions, other things can happen. So the 13F may either be out of date in terms of the fund's holdings, or it could be out of date in terms of the thesis, because these stories can change on a dime if the clinical data or the regulatory event changes the story. So you have to be aware of that. And you obviously have to have an educated view as to who you think the best investors are. And even the best investors get things wrong, right? When I left being a full-time institutional healthcare investor, that was my theory. And I think we talked about this when we met for lunch. Like, my theory was the way I was going to stay active in biotech and run my personal portfolio was I was just going to follow the 13Fs of my smartest friends and basically piggyback off their ideas. And I found that it worked only up to a point because, particularly with positions where they were binary event heavy, you still had to be following them like a hawk. I think it can work if I would say the way to use 13Fs in biotech would be, first of all, you have to have, again, a really educated alpha view of who the best investors are. Because there are plenty of brand name investors out there who have a big brand, who have a lot of assets under management. But like I personally, my regard for them may not be correlated to the AUM that they have. And then the second piece is, I think, focus on their very largest positions. Because if you focus on their top handful of positions, or maybe the positions where there is the biggest delta between the last quarter and this quarter, but particularly the largest positions, because if let's say you're a $6 billion fund, your largest position is effectively relatively illiquid, right? Because it's going to be in some stock that you you have to have a core position. You have to have a 5 to 10 year horizon on the story, because you can't just trade in and out of that very large position so easily, especially if you're looking at these sort of, 9-digit market cap biotech type stories. So I think that would be how I think about the 13Fs. But I think you also have to layer on, just as a what's going on in biotech in general, right? Biotech has been like Japan lost decade ever since interest rates went up in 22. And I think what I observed in my now 25 years of being involved, first half of my career as a institutional biotech investor, and second half more as a leisure, a biotech investor of leisure. What I've observed is that monetary policy has a big impact on biotech. Everyone thinks they're a genius when interest rates are at zero and there's QE, and there's billion-dollar market caps for biotech companies that literally don't have a single drug in clinical trials. I remember in the late 2010s, early 2020s, late 2010s, early 2020s, looking at some of these stocks and being like, how does this company have $1 billion market cap when they literally do not have a single drug in the clinic? When I was in the business, you had to have a phase 3 clinical trial drug that people thought was going to work to have $1 billion market cap. Now you have theoretical technology platform plays getting $1 billion.
Right.
To me, that's when I really started moving away from the space and moving more into Bitcoin, because I'm like, I don't know how to value a company that has no drugs in clinical trials.
An idea and a dream. I saw a biotech company that's literally going to cure the common cold. I'm like, all right, this is either fool's gold or it's a diamond, probably fool's gold, base rate probability. By the way, biotech, as you know, is one of the hardest categories to invest in. The vast majority of these names will not do well. It's actually the original animal spirits.
I love it.
Right? Remember past .com era with Craig Venter? You had the first epic boom after they decoded the human genome. These things went ripping like crazy.
Yep.
Then there was a massive crash because the actual delivery didn't show up. It was like a 10-year, 12-year bear market. And I agree, because they're unprofitable tech, they thrive off of easy money conditions. And when the IPO markets are open and animal spirits, are cranking. Now, though, animal spirits are in digital assets, or they're in crypto equities, or they're in other types of stocks, like say Robinhood or Circle, et cetera, the CoreWeaves of the world and data center plays. So I think that's one reason why biotech hasn't done terribly well. Then on top of that, you've got policy risk around supply chain tariffs hitting pharma to some extent. To some extent, that impacts biotech as well.
The Medicare negotiating drug price is something a lot of people talk about, a lot of people are worried about. And those things are real risks in a way with some companies. I do think that they're somewhat overstated. I mean, they're not nothing, they're not unimportant, but I think the bigger problem right now in biotech is you have a lot of companies that raised a lot of capital in the ZIRP environment, and now the capital has dried up. And people are kind of having to live off what they raised 5-10 years ago. And, there's much more discipline now. People are really focused on the best ideas, and you can't get, a huge raise for your preclinical theory. And that's how it should be, frankly. And so I think we're still in that sort of, what's the expression? The python eating the elephant. The elephant still has to kind of worm its way. The elephant cash that all these companies got in the ZIRP environment still has to work its way through the digestive system of the python. And then once we get through that, I think we can have a more meritocratic environment for valuation.
Yeah, no, I agree. At the end of 2023, we were looking at biotech, and we noted that many of these biotech firms were trading below net cash.
Yeah.
Meaning you liquidate the company, you say
about a quarter of them are right now. Yeah.
Right. And then you get net cash. The difference, of course, that they were still unprofitable. There's trading below net cash. You got a melting ice cube. The cost of the ice cube is less than the value of the water, so to speak. But the water is also evaporating in the air. And that set off an incredible rally. But that's behind us now. How do you think about kind of an adjacent but more mature sector like pharma? If you got stocks that are incredibly cheap by historical standards, obviously there's policy risk impacting that. They have low teens PE ratios. Is there opportunity there, or do you think it's better to wait for more policy clarity, especially around supply chain?
I mean, it's a stock picker's game, right? So if there's a particular company where you really believe they have a blockbuster, the next GLP-1 or something of that scale, the next Alzheimer's drug, you can imagine. I mean, that's what drove Lilly to where it's at. That's what drove Novo Nordisk to where it's at, right? So if you have a thesis around a particular drug that you think is going to be really big, then you can justify a lot of things valuation wise. But it's not a sector play. I think that as a sector, they're fairly valid. And I think one thing that there are diseconomies of scale in pharma. And what I mean by that is the larger you get, the less productive your R&D engine is. So we've actually done a lot of work on this at FreeOp. I'll put an article in our chat about it. We did a huge study, and it was based on my experience as an investor on Wall Street. It's these startup venture-funded biotechs where the new drugs are coming from. Like for example, during COVID, we kept talking about the Pfizer vaccine. Pfizer didn't develop a COVID vaccine. They acquired the rights to a German COVID vaccine from a company called Biotech, which was a private company that didn't have the savvy to enter the U.S. regulatory system. So Pfizer did it for them. So Pfizer was the regulatory arbitrage. They didn't actually contribute anything technical or technological to the success of that product. And that's what basically the big pharma companies have become. They've become financial and regulatory arbitrageurs, where they have the capital and they have the lobbying muscle and they have the relationships with the FDA and they have a US-based sales force. But they don't actually have the innovative scientists, because if you're like the Ram Alwala of Pfizer, you're like a super genius who's working in the bowels of Pfizer, and you've got this great idea for a new drug, and you succeed, at Pfizer you'll get a plaque on the wall that says you're Employee of the Year and maybe a $10,000 bonus. If you spin out of Pfizer and you start a biotech company and you've got equity and stock options or RSUs in that biotech company, you can make $100 million. So which path are you going to choose?
Right.
Every talented scientist at a large pharma company would rather be at a startup. And so all the smartest scientists who have developed the new drugs are not at big pharma. They're at these smaller companies. And so it's the big companies that are constantly lobbying Washington saying, you must let us charge really high prices for our 20-year-old drugs, because otherwise there won't be any innovation. And it's a total lie, because they're not the ones actually doing the innovating. It's the companies that actually have no revenue that are doing the innovating.
That's fascinating. They spin out of the pharma company. They go create a startup with the idea of getting acquired back at their old shop. And so it goes. I mean, similar things happen, of course, in Silicon Valley. You spin out, you start an AI company, and you get acquired back into the company. So fascinating category. Let's talk about digital assets. So in the past, I believe you've argued that Bitcoin is a kind of insurance policy against inflation and monetary policy. How do you think about that as an asset?
Yeah, I mean, look, I wrote an essay 4 years ago where I put a lot of these thoughts together that I'm happy to share, called Bitcoin and the U.S. Fiscal Reckoning, that was sort of you could say my coming out party as someone who publicly was pro Bitcoin. Mm-hmm. And basically I wrote this article in a quarterly policy journal called National Affairs to basically explain to Washington why Bitcoin was not video game money. It was not a passing fad. It was going to be increasingly important as the debt continued to rise, and why Bitcoiners actually had a reason to care about what Washington thought of Bitcoin. Because 5-10 years ago, the consensus in the Bitcoin community was, we're a censorship resistant permissionless network. It doesn't matter what governments do. We can operate Bitcoin independently of governments. And I like to think I helped convince Bitcoiners that actually the government can do a lot to make Bitcoin harder to use for payments.
Right.
The government can do a lot to make it harder to spend your US dollars to buy Bitcoin or to sell Bitcoin back into US dollars or fiat currency. So there's a lot of things that the government can do to make Bitcoin less usable by preventing it from interacting with the traditional financial system. The ETF battle that you know extremely well is a great example of that. And on the flip side, my argument to Washington is, hey, you're not going to be able to run $100 trillion, $200 trillion debts, because eventually the world will realize that the dollar is going to have to decline massively in value to pay off those debts. And Bitcoin will be what people flee to. They didn't have an instrument to flee to before, because where were you going to go? Were you going to go to the euro or the renminbi? You really couldn't, but you can go to Bitcoin. And so that's my basic thesis. It's not, one thing people will say is, well, hey, Avik, you say that Bitcoin's a hedge against inflation. Well, the CPI printed this yesterday, and Bitcoin traded the other way from your thesis. Like, that's not the point. It's not a hedge in a trading sense against like a random CPI print or PCE print. It's a hedge against long-term inflation. It's a hedge in particular against a long-term debasement of the value of the dollar, which is happening and is inevitable, because the only way to finance the debt over time is to decrease the value of the debt by decreasing the value of the dollars that the debt is denominated in. So that's what we have to do in order to basically afford our debt. That's what every debtor nation that's gone out over its skis in terms of debt, national debt, has had to do. And the U.S. is not immune from that math. We just have the advantages of the world's global reserve currency, the Basel III regulations that basically require people to hold treasuries, and a bunch of other, the liquidity of the treasury market being so vast. There are some advantages like that the U.S. Treasuries market has, but that doesn't mean that eventually you still won't have these problems. And so, I think I'm pretty relaxed about it. Unlike a biotech stock where I constantly have to worry about, okay, how did that clinical trial go? Is there some rumor in the market that I'm not aware of? Did some guy downgrade the stock? What's going on? You're always having to follow the news flow because these things are flying around like, stealth fighters in a dogfight. With Bitcoin, it's no more or less volatile than your average biotech stock, actually. That's why the volatility of Bitcoin never bothered me, maybe. But it's a long-term play, right? It's a play that, based on my math, we only have about 20 years max and probably less before the math stops working fiscally and we have a bond default or a bond market failure.
Are you in the Ray Dalio camp? He's obviously been very visible.
Yeah, Ray, I would say, is more optimistic than I am.
He's pretty dour. He's fairly dour.
He is, but he has also done a lot of studies, and he'll look at the Argentinas and the and the Russias, all these countries that have defaulted in the past. It's like, well, Argentina's defaulted and Russia's defaulted, and these countries eventually did come back, and they came back because of X, Y, Z, ABC reasons. So in that way, he's more sanguine. I think that having the world's superpower with the world's reserve currency default is a much more globally catastrophic event than Argentina defaulting. And I think that Ray, at least based on, I haven't read his most recent book, so maybe he addresses this as his most recent book that just came out. But in the ones that he's published before, I don't believe he's accounted for that unique problem with the U.S.
He's in the debt spiral issue. That a sovereign can always print its own currency and monetize its own debt and embrace modern monetary theory. Not that it's modern. It's called Weimer hyperinflation. We saw it before. Had pretty bad outcomes for Europe. It's I would say that the nice thing about Bitcoin and the way it's very different from a stock, right, is with a stock you always have to have a price target. There is there comes a point where you're like, okay, if this company takes over the entire global market for electric cars, its price will be X, and if its price is above X, and possibly if its price is near X, it's valued for perfection, right? Bitcoin is not like that, because basically Bitcoin today is valued at, let's call it $2.2 trillion of value or thereabouts. That's a very small fraction of global assets. And, it's even like, let's call it 1/5 to 1/10, depending on how you count it, the value of all the above ground gold in the world, right? So if you believe that Bitcoin's more useful than gold, which I do, because you can't ship your $1 billion of gold across the world. Portability.
Lots of people stopping you, whereas Bitcoin is easy to send value as an email. if you believe Bitcoin's more useful than gold, then Bitcoin should be have a higher market value than gold over time, at the very least, if not much more than that. So if Bitcoin does become the world's reserve currency someday in 20 years, say, it's going to be a lot higher than $117,000. So in that sense, I'm very relaxed about Bitcoin. I don't have to worry about it. I don't have to worry about its price swings. I don't have to worry about the news flow by and large. I just have to believe that Bitcoin will solve some of the long-term technological challenges around quantum computing and making sure that the group of core developers that maintain the software continue to do a good job. If you believe in those things about Bitcoin, then Bitcoin's going to be fine.
There's a whole quantum decryption thing. I think we probably get 8 to 10 years on that, unless AGI comes out in 3 years from now, and then the very next day it cracks Bitcoin. That's the other trap.
Yeah, these are all tail risks, and you can't completely discount the extreme tail risks. But I think I would put it this way. I think upgrading the cryptography of Bitcoin is not technically hard. It's just that you don't want to do it too soon, because if you do it too soon, upgrading the cryptography would mean a much more clogged, a much slower network.
Right.
So there are near-term costs of upgrading the cryptography well before quantum computing is ready for prime time. So I think that the view of the people who are on top of this stuff is that we have some time before you really have to upgrade the software, but we know how to upgrade the software, and it can be done in short order should it be necessary.
Yeah, no, it's a great point. And to your point, I'm showing here on the chart, the DXY, you can see the US dollar index hit a peak January of this year, and then it's dropped since then.
Killed my summer vacation, man. My summer vacation was like 20% more expensive.
Well, that was the comment last year, that Americans were touring Europe. And 2 decades prior, as Europeans were touring United States. So now if I take a longer term view of the US dollar, I mean, it has substantially dropped below its historical trading level of the last few years. Now with the big beautiful bill and 8% GDP deficits, the dollar declined with respect to all of that. We'll see though. I mean, I still think like the US dollar is the least dirty shirt in the world. Like, where are you going to go? It's not the euro. Euro's got its own issues. But there, Bitcoin is participating in this general idea of the commodity super cycle. Like, you can look at like uranium, look at platinum, look at commodity prices. Bitcoin as a commodity is increasing in value. And there is this general idea of dollar debasement. I'm seeing more RIAs incorporate commodities and including digital assets into their portfolio. It might only be 1 or 2 points, but I am seeing that play out. I'm skeptical Bitcoin gets above 125K in the very short term, though. It's struggling. It got almost there yesterday. And the reason why I say that is I've got a lot of people on our wait list are like, Ram, as soon as Bitcoin hits 125K, I'm going to sell and let you manage it. So Mr. Market's is going to deny me that opportunity. So that's what I see in the next few weeks. We'll see how it plays out from there. Any other concluding thoughts, observations on any of the above topics?
Yeah, I mean, on just what you were just saying, DXY is not the ideal instrument to look at the dollar from my vantage point with my thesis, because DXY is comparing it to other fiats, right? So, like, compared to the yen or the renminbi or the euro, and the land of the blind, the one-eyed man is king. I'd say the euro, because of Germany's fiscal rectitude is perhaps the best of those currencies in terms of just fiscal policy.
Yeah.
But broadly speaking, the thing I look at is the dollar to gold, right? Or if you want to look at the dollar, if you don't want to look at Bitcoin, look at the dollar to gold, because that's really telling you the view of the market in terms of fiat versus a non-fiat, traditional non-fiat asset. And what that tells you, because gold is obviously rallied against the dollar considerably, that people's confidence in the dollar is going down. Another thing you can look at is the share of treasury securities owned by international investors. And what that shows you is that there's been a massive decline over the last 20 years in the share of treasury issuance that's held by ex-US investors. And so that's telling you a lot about those two charts tell you a lot more than the DXY about what the market really thinks of the US dollar. And I think all the signs are pretty negative, especially when you layer in what's going on with the federal debt. We haven't really talked about the federal debt in depth here. And one thing I would just share that I've written about is that the federal debt picture is far worse than what the Congressional Budget Office's official projections show, because which are bad enough, right? So the
Great point.
CEO says the debt to GDP ratio now is at World War II levels, and there's no World War II happening, at least to our knowledge. So that's not great. And the fact that in 20 years, CBO projects that to be 200% of GDP, Japan level, debt, that's also bad. But the problem is the CBO is assuming that there's 3.6% GDP growth forever. The CBO is assuming that we can borrow at 4.5% interest rates forever. We're not
and the expiration.
Borrow at 4.5% and grow at 3.6% forever. And if you actually just make it 3% rather than 3.6%, you get 600% debt to GDP.
I'll give you a give and a take there. So look, I agree. And the CBO estimates don't make any sense. And in part because they also assume expiration of tax cuts. So then there's this revenue there. Revenue is really taxes, by the way, for people that are listening. It's just taxes. We call it revenue because it sounds better. That's one. But the other part is that there is legitimate productivity growth that we're seeing, and we haven't seen it at this level since the late 90s. And I do believe it's driven in part by increasing contributions to AI. And you're going to see more diffusion of that around the economy. Unfortunately, we've seen it drive up healthcare spend, to your point. But I think we will see more of that benefit the economy. So I'm not concerned about the debt blow up happening, for that, and just kind of the Fed can monetize its own debt reasons. But I acknowledge your point of view, and I think it's legitimate and needs to be seriously considered.
Yeah, I mean, the way I'd put it is a lot of people focus on, think of default in a very formal way. Default means I owe you $10 and I don't pay you $10, I pay you $5. What if I owe you $10, but I cut the value of $1 by 50%? So I've still paid you $10, but the value of that $10 is
off default,
equivalent of $5. Right. That's inflation. That's debasement, right? So debasement, the fact that we inflate the US dollar deliberately every year is a form of default.
Right. It's a soft default. I mean, you see it in rising prices.
And markets are smart enough to figure that out, especially if they have alternatives.
Right.
And they now do.
Terrific. Avik, it's been absolutely a blast to spend time with you here today. How can people follow you to learn more? How can they learn more about your nonprofit and research?
Yeah, so thanks a lot. My nonprofit, the Foundation for Research on Equal Opportunity, or FREOP, is freopp.org, like my logo here on my vest. And on Twitter, I'm at AVIK, like my first name.
Early Twitter adopter. I like it. Good handle.
Thanks.
Terrific.
It also helps to have a funny name.
Until next time, make it a great one. Be well now. And thanks everyone for joining Lumida Non-Consensus Investing. You can find this on YouTube, Spotify, Apple Podcasts. Just look up Lumida Non-Consensus Investing. Until next time, everyone, be well now.